Good evening. Welcome to the Maximizing Your Money webinar investment edition. And well, before we actually start the talk proper, let me introduce myself. I am Georgina. I will be the moderator to facilitate the discussion today. And let's go through some of the admin details that matters to you. Okay, the chat function for this Zoom, it will be used to broadcast messages. Okay, so if you have any questions, you can submit your questions through the Q&A tab. And please do not share your personal details in the Q&A tab, all right? Okay, now if the video is not moving, generally, if you leave and rejoin the session, it should be done. All right. And last but not least, it's not in the slide right now. That is, we will have polls coming up. Do join us. We currently have about 320 participants, and I see that a lot of you are joining us again. And good evening, everyone. Welcome to Maximizing Your Money webinar. Okay, so it's great to see many of you tuning in here. And this evening, we will navigate the 101s of investing, how you can plan and manage your investments. Okay, and of course, answering all the burning questions you have. So I presume that you know that when you registered, you actually can ask a few questions. We actually check through the questions and make sure that what we're going to go through today are mostly covered. If not, it will be during the Q&A session. So joining me today, the panelist here is Gregory Van, CEO of Digital Wealth Advisory Platform Endowas. And we have Jun Xi, okay, our CPF volunteer who has started investing really early on his own. He will share his investment journey with us. And last but not least, my colleague Hui Bing, Hui Bing, Senior Deputy Investment Director from CPF Board, and she will share with us more on CPFIS. Okay, now let's get to know the viewers better. Let's have a poll right now. And the poll is a very simple question, or rather two simple questions. Okay, the very first question is, how confident are you in investing? Okay, the rating scale of 1 being least confident and 5 being most confident. And the second question is, are you currently investing? All right. Okay, so actually I have a question for all of us here. I mean, I started really late in investment at the age of 30. And if you ask me at that point of time whether I'm confident, I would say 1. But I thought, why not? I should start now, right? How about you, Greg, when you started?
I probably, when I started, I probably thought I was a 5. But I should have been a 1.
Okay. We will know more about that later. How about you, Jun Xi?
I think same. But after the first time, I was always a 1.
Okay.
Gradually build up to maybe a 3 or 4.
All right, let's see whether this is related to gender, okay? So what about you, Hui Bing?
I started investing when I was about 20s, early 20s, when I started working.
How confident were you at that time?
Confident. I thought I was quite confident. But actually, I should not have been so confident.
Okay. Let's take a look at our viewers right now. Let's show the results. I'm actually looking through the phone to look at the results right now. Okay. Okay. Oh, okay. A lot of you are in the middle. 40% of you actually rated 3 out of 5. Only 2% rated 5 as for confidence level. Okay, and a good 22 and 25% actually rated 1 and 2. Okay, so guys, our KPI today is all of them moved to 5. All right, I'm kidding. Okay, so let's take a look. Okay, wait, hold on. One more question. Are you currently investing? 75% of you, yes. That's good. 25% are no. And I think some of the questions that y'all have asked, for those who said no, we will definitely cover during the discussion. Okay, so Greg, the first question is for you. Before we start, on like the options that we have for stocks and investments, I think we should really explain what is investing.
Yeah, no, it's a great question. Actually, it took me a long time to figure that out myself. And it was through my own investment journey that I went through different phases to finally, I think, be investing properly. Now, to go through the phases, I think when you first start saving money, we usually keep it in the bank, or even earlier, we put it in a piggy bank at home, right?
Without interest.
Without any interest, yeah. Actually, my parents took the money, and they didn't pay me any interest. I didn't realize.
Oh, dear.
Yeah, like my hongbao money and everything growing up. So what you realize is that what you can pay for when you get that money, and then what you can actually use it to buy at that time versus 10 years, 20 years, 30 years later is very different. So saving is great. You have very little chance of losing money, but you have almost guaranteed risk of decreasing purchasing power of that money. And we feel that more with inflation. And we talk to a lot of clients who are very late in their journey, so they're past retirement. And even them at 60 plus are coming to us and saying, hey, I actually need to invest because I'm gonna live until 90 and I already see my savings decreasing in value. And then we have the 30 and 40-year-olds who have been seeing this happen as well for their own savings. Maybe they're supporting their parents, they're also supporting their children, and they're like, hey, I can't just save.
So, I mean, sorry to interrupt you, but
Yeah.
it can be done, right?
It can absolutely be done. So then you move on to the next stage. So when I started investing, what I was actually doing was speculating.
Yeah.
Okay, so
Where your confidence level was 5.
my confidence level was 5. I made my first investment. I thought I was a genius. I made like 7% in a few days. And I thought, this is so easy. Everyone said you should only make 7% a year. I made 7% in a few days. So I thought it was really smart. Anyhow, I was day trading like crazy. I think a lot of people went through this in the last few years as well. I was day trading like crazy. I think at one point my portfolio was up like 300%, and then it was down 90% a few years later. Okay, so that's when I was like, there has to be a better way to do this, because I spent so much time and effort trying to figure out how to invest and grow my money, when in the end of the day, my outcomes were random for the risk I took. And when you get into all the academia, so all the research about this, you realize that investing is actually, or evidence-based investing is what we call it, is actually getting a return compensated for the risk that you take. Right? And there are ways of doing that. There are techniques to do that, which I hope to share later on. But very importantly, investing should also be towards your life circumstances. Right? It should be geared towards your goals, when you need to use the money, what you can tolerate behaviorally from a risk perspective, to determine how you should be investing that money.
Okay. So I guess one of the things that the viewers have asked is this: they have read all about the stock options, they understand the definition. So how do they start? One of the questions that they asked was, what is the current market outlook for investing right now?
Yeah, so I mean, I think it's a great question. This is a longer term history of markets that we're seeing here on the chart. I think, yeah. So what you see is that when you take more risk by investing in global stocks, the return is higher. This is over 53 years. The return is higher, but you also tolerate more ups and downs. So what I wanted to highlight in this chart is actually the biggest down. So it's very rare when someone's like, when someone's telling you about what to invest in, that they tell you, oh, but this is the biggest decrease that you've ever experienced. And what you see in longer term stock markets, and when you're diversified, so you're getting compensated for the risk that you take, is that the stock market goes down by 20% at least once in every 10 years. It goes down by 50% at least once every 30 years. And that is the market readjusting itself. Okay. Then you move to bonds, slightly lower return, so 5.7 versus 7.9% over this period. But you can see the insane and dramatic power of compounding over that period. From $1 to $18 for the long-term government bonds, and $1 to $53 for the global stocks. And that's the difference in compounding at 5.7% versus 7.9%. Okay. Then we move into safer things like U.S. Treasuries. They have a longer history. Singapore Treasuries are not too different. And then the 2.5% per annum for comparison. So yes, if you get 2.5% per annum, you never have a chance of going down, so negative 0%, but you also end up with 3 times your money, 3.7 times your money, versus the possibility of 18 to 53 times your money in a similar period. But taking into account that you need to tolerate these ups and downs. Now then you ask yourself, why? Fine, I see that it goes up, but why does this relationship exist? And it's actually ingrained in the way the capital markets work as a whole. So if a company goes bankrupt, the bondholders get paid back first before the stockholders. And if we've been following the news recently, we've seen this happen with a number of companies globally in recent months, right? Silicon Valley Bank, Credit Suisse, and others. So the bondholders get paid back first before the stockholders. So therefore, the stockholders are taking more risk. And therefore, the market is constantly adjusting itself so that buying stocks pays a certain amount of return over risk. Now, this varies company to company. So rather than trying to do this for a single company, you should try to buy the entire market so that you get that broad diversification of risk. Okay, but coming back to your very specific question on the market condition today, we've seen an increase in interest rates, an increase in inflation. People say, oh, we might be near the end of interest rate hikes. I prefer not to take a view on that. I think you need to be investing based on the amount of time you have before you need to take that money out. Looking at this 50-year chart, there have been many periods of high inflation, high interest rates, global financial crises, budget deficits, wars, etc. But in the end of the day, this relationship exists because if you take more risk and you are diversified and smart in the way you are getting exposure, you can get compensated in return as long as you have enough time. So people's like, well, you can look at this chart. I'm not hiding anything. It has gone down sharply in the recent part of the chart, about 20%.
Yeah.
And essentially what's happening there when interest rates go up is money is moving out of the stock market to say, hey, I think the risk-return trade-off of owning treasury bills is better now. So I'm going to move my money out of the stock market and into treasury bills. But see, that money flow ends at a certain point of time when the stock prices are what they think is fair for the risk that is being taken. And these stock prices are changing nonstop all the time. You'll go crazy if you try and watch them all day. You'll go crazy.
Yeah.
So you shouldn't, to me, investing is not trying to watch that ticker up and down, up and down, up and down. It's about sitting back, investing in an intelligent way, in a way that suits your life goals and what you can tolerate from a behavioral standpoint, and position yourself properly within markets based on your goals.
So we have to do some homework first. We need to know we need to know more about ourselves, the risk tolerance and all that. And then diversification, like you say.
Yeah.
It's not about one type of industry. It's like, if we can try many industries, buying the stocks from there. And aside from stocks, there are bonds and T-bills.
Yeah.
Whew.
On diversification, just one more really quick pointer that a lot of friends usually ask. And I'll use a very sort of a local example. So friends might ask like, hey, should I buy UOB, DBS, or OCBC? And they're comparing the little nuances across the three. They're saying, well, I like this one's app more. I like this one's offering a higher fixed deposit rate now. This one's blah, blah, blah. But actually, why buy one when I can buy all three? Right? The risk-return trade-off of owning all three is much better. I still get to capture the growth of Singapore banks. And then you take that a bit further. Why buy just 3 bank stocks when I can buy global bank stocks if I believe in banks? But then you take it a bit further again. Why don't I just buy all the stocks in the world because the market is constantly adjusting the prices of all of them. And actually, it is those who are able to get that really broad global exposure that have a higher probability of being compensated in returns for the risk that they're taking. So I'll stop there. I could go on forever on this theory, the theories around investing, because I got crushed personally in my early investment journey or early speculating journey. So I think these are really important foundations.
It's always from the experience that we learned.
Yeah.
Okay, so I have actually one more question for you.
Yeah.
So you can continue to talk.
Okay.
Okay, and that is, how should a beginner really start investing? I mean, we have talked about know what you should invest. I think most importantly, the time horizon. Yeah. Be whether we are in our 30s, 40s, or 60s, we can invest, right?
Oh, absolutely.
And it's about your risk tolerance or the level of risk that you want, and what at the end of it, what do you want to get out of it? So we talk about stocks, but let's briefly talk about the following products like ETFs, REITs, in case some of our viewers are not very sure what are these products about.
Sure. So ETFs are, we call it ETFs all the time now, but it's actually just electronically traded funds, and they're funds that are listed. Okay. Not too different actually from unit trusts or mutual funds. Those are funds that are not listed, right? And what's more important when deciding if I should buy an ETF or a fund is what exposure you're getting, what fees you're paying to the fund manager, what fees you're paying for the transaction, if there is a fee. And very importantly as well is and I'll talk about this a bit later, but how the platform I'm using is getting compensated. So how they're earning fees. Because for example, if I'm earning fees on when you transact, I might be more incentivized to make you transact more so I can earn more fees. If I'm earning fees as a trailer fee from a fund manager, I might be incentivized. So that's like a sales commission that a distributor can collect from a fund manager for selling a certain product. I might be more incentivized to push you or sell you products that pay higher sales commission trailer fees. So I think it's very important, and more people are becoming aware of the different fees involved in investing. But when it comes to just getting started, I think what you said was absolutely right. Like, what is your risk tolerance? When do you need to use the money is a really important question. I actually think when you need to use the money is the first question you should ask, and why you're investing, right? What are you investing towards? Rather than a lot of people, the first thing they ask is, what should I invest in? That's not the first question.
And they ask, what is the amount that I have to set aside to invest?
Correct. Yeah. So they're very obsessed with just tell me what to buy, right? Because I think we've been trained to think that way.
Yeah.
But actually, I go back and say, no. Why are you investing this money? When do you need to use the money, right? And then we can determine what and how you should be investing. But if you're really, and I think your poll said 25% are not investing yet, I think it is invaluable experience, invaluable to, yes, invest part of your money, but also try to do the speculation thing on the side if that's of interest to you.
Okay.
Because until you sort of scratch that itch, you won't believe in the research. Okay, so it's like it's a training process.
Yeah,
okay,
yeah.
so I'm not saying like, okay, you have to invest the endowus way. Of course, we think that we're giving a very evidence-based approach that everyone is able to use and access and understand with really best-in-class products already curated and screened for our clients. But I know from talking to my friends, my siblings, even my parents, going through it myself, everyone has an itch. So
Yeah, and I think a lot of times you understand it theoretically, you see your friends doing it and you go like, oh, okay. But only when you're in it, you know how it feels.
yeah, I mean, it's your hard-earned money. It's your hard-earned money,
Yeah, that's the
and you're seeing it go up and down, and it can be extremely nerve-wracking. So I think it's important that you understand the evidence behind how you're investing so that you can do the right thing and you can sleep well at night
Yeah.
knowing that you've done it well.
Yeah, I guess that means that we should also only start the amount that we want to set aside for investment is also the amount that we can afford to risk, to afford to lose. Would you agree with that?
I don't agree with that philosophy.
Ah, okay.
Because if you are diversified, and you're investing in an intelligent way, it's not like I'm investing $100. I need to think that, okay, I'm ready to lose $100. Right? That's the
yes,
way.
that's not the right mentality.
That's not the right mentality. That's the way I would think
Yep.
if I went to MBS, which I don't do. But
You wouldn't know, but yeah, okay.
okay, but that's what that's what I'm trying to say is like if someone goes to the casino
Yep.
and they take some cash out and they throw it on the table, they're ready to lose that cash.
Okay.
Okay, that's gambling.
Okay. Yep.
We're talking about investing here, so I would frame it very differently. Another thing to do if you're just getting started is to build up your portfolio. You can easily dollar cost average, or what they call like RSP, recurring savings plan, invest on a monthly basis. And that is a very good behavioral way to automate. And therefore, your cost, whether the market goes up or down, you're basically averaging your cost every month as well. And just say, you know what, I've made this decision. I understand why and how I'm investing, and I am automating it away from myself. Right.
So it's also more like invest for the long haul sense. Okay, I have a question for Hui Bing. Now, what if the viewers, they don't have the cash currently, and they are asking whether they can use the CPF savings for investment? What is our view here?
Okay, you can use your ordinary account savings for investment if your OA has more than 20,000, or you can use your special account if it exceeds 40,000. But first of all, you have take note that the special account or SA pays you risk-free return of up to 5% per annum, and our SA savings can grow greatly if we let the compounding work its effect over time. So before you invest, it's a good idea to build out your safety net using your CPF first. So for members below age 55, you can actually use your OA to top up your SA and earn up to 5% per annum. And for members above 55, you can use your OSA to top up your RA and earn up to 6% per annum. But of course, we also understand that members want to earn higher return for their OA savings. So for such members, if you have a lower risk tolerance and your investment horizon is relatively short, you can put your money in fixed deposits or treasury bills.
Okay. Phew, we're safe here. Yeah, because the thing is that using your CPF savings for investment is not say a no, right? Yeah, I guess it's the same as how we want to look at our entire portfolio, our risk tolerance, what we want at the end of the day, or how much we want to get at the end of the day, before we actually go into what are the options that we have that we can play with. Okay, I actually see Jun Xi, kept nodding his head when Greg and Hui Bing are talking. Yes, I can't wait to hear from you, your investment journey here. Yeah, do share with us, how do you start?
How do I start? Wow. Okay, so for a disclaimer, I'm in my early 30s. I started investing when I was 20. So that's about 11, 12 years.
Okay.
Yeah, guess my age. Okay, so going into investing, I think it's just to have more interest in growing my money, to make it compound over the time. So when I was young, right, I started reading books about financial planning, investing. So one of the key things that sparked me to invest was about retirement. Like how do you actually have a comfortable enough nest egg when you retire? So to do that, you have to invest and also do it consistently over the years of your working life, all the way until you actually retire. So being young, I say, oh wow, that's great. I shall start now. So I can compound interest do his work for me. So that's how I go into investing and also speculating first. So I didn't really invest actually, rather I speculated in a certain stock that I won't reveal what it was. It's still listed now in the SG market, but I won't reveal what the stock was. I actually lost money due to the investment. So that actually led me to do some research on my side, how to make better choices to invest, and so what to invest in.
Okay, so I see from what you have shared with us that you focus on stocks and REITs.
Yeah.
Would you want to share with us?
Sure. Okay, so for me, for my own personal investing strategy and also my own risk tolerance, I look at stock and risk for two reasons. So stocks are basically there in my portfolio for the growth portion to give me possibly accelerated returns to my portfolio. Risk, on the other hand, is for their dividend payouts to have actually a stable, recurring dividends every year or every few quarters. So that for me is the income portion of my portfolio. Yeah.
Okay. Okay, so I think I have a burning question. So do you use your ordinary account funds for investment?
Oh, actually, I do not use my OA to invest. Okay, so for OA, right, I actually transfer it to my SA, actually hit the full retirement sum.
Oh, okay.
So why I do that is very simple. To me, my CPF is my safety net in the event that, touch wood, if there's no wood here, but anyway, touch wood, if my investment goes wavy, right, I still have that safety net for my retirement. So to me, the CPF is my safety net for retirement, which is why I do not touch it for investment as of now at my age. I would rather use it to hit my full retirement sum and then consider investing after that.
Okay. You know, we have always been talking about starting investment early. I just want to delve a little bit because there were really a lot of questions from people who are in their 40s, 50s, and even 60s that are keen to invest. Actually, because of the recent years, the news that they have heard, and I guess their friends have been doing it. So we know that it's not too late to start investing, but are there any recommendations on how they should, what they should do, what are kind of the stock options? That's also provided they have done what the homework that we are supposed to do. You know what you want at the end of the, what is your end goal? Okay, how much you want and when you want it. What is your risk profile? Yeah.
For sure for me. Yeah, okay, I will answer first.
Yeah.
Okay, I'll answer
you
first.
You're ready to.
Okay, so what to invest in? Okay, so for me personally, I look at three factors. So basically the risk-free rate, the cost involved in that investment, and also the own company's own research and results over the past few years. Okay, so I'll touch on the risk-free rate first. So what is risk-free rate? So basically risk-free rate is basically the returns that you get from very safe investments. So for example, treasury bills, Singapore saving bonds, Singapore government bonds, local banks FD. So currently the risk-free rate is ranging around 3.5 to 4%. So if I were to invest in a product or a stock or a REIT, for example, the expected potential returns has to exceed this range for me to take up that risk of investing in that product or stock or REIT. So it does not exceed that return that I want, right? Why should I even invest in the first place? I might as well put my money inside the FD or even in the treasury bills. So that's the part on risk-free rate. So second portion is the research portion. Okay, so that, if you ask me what to research, there's tons of things to research. There's a lot of things to research. Okay, so if you invest into individual company or REITs, okay, I'll start with companies first. So what to research, right? Okay, companies, because basically they are a business. They have to earn a profit to continue surviving in the market. So how do you actually find a good company to invest in? You look at their financial performance over the years. How much revenue they have had? Are they profitable? Are they generating cash to every year? Are they positive net cash flow or negative net cash flow? So you look at things like this. And the other aspect of it is also the more quantitative aspect, the more emotional-based aspect, which is how to look at the company growth prospects. Like, can it grow? Can it beat the competitors over the long run? Like, what is its product's competitive edge? Like, how are they going to rank up against their competitors? Can they survive the competition or not? Yeah, so that one is more, it's not that easy to see because you cannot really judge the future. But once you do it right, you can actually start to realize that there are certain companies that have a competitive edge, be advantage in be it technological wise, or in terms of sector, or in terms of location wise. So that could possibly outrank them over the foreseeable future. So on the part on cost, right? Okay, so if you invest in ETFs or mutual funds or unit trusts, there's this term called the total expense ratio, or in short form it's called TER. So that is the maximum amount of funds that the company managing an ETF or the mutual fund or unit trust can get for you every year, which is per annum. So for example, you can see TERs ranging from as low as 0.04, 0.1, all the way up to 2 or even 1.5%. So depending on what product you invest in, obviously note of the cost involved in it, because this cost, right, it can compound to quite a sizable amount over the years, over the long years that you are investing in that product.
Okay.
So I have a very different perspective
Do share.
on how to invest. I would say, similar to when I started my own speculating journey, I thought that doing a lot of research on single stocks would be efficient and effective, and that I would have certain insights that other people did not have. When I made a lot of money, or not made a lot of money, it was a small, I had a very small amount of money I was playing with, but when I had a really great return, I thought it was working. And then when I got crushed, I thought something did not work well. So I started doing more research into how markets actually work. And what you realize is, in the stock market alone, globally, over $500 billion per day, $500 billion per day changes hands. Okay, so someone buying a certain stock, someone selling that stock. You have to realize the stock prices change only because a transaction occurs at a particular price. So someone buying thinks it's a good time to sell. Someone selling thinks it's a good time to buy. And this just keeps on going on and on the whole time. And it is very difficult. I mean, basically that price of a stock already cooks in all perceptions collectively about the stock, right? It doesn't matter if I'm a big hedge fund manager, if I'm a college student investing for the first time, if I've never invested in a stock before, if I'm 85 years old, I've been investing in stocks my whole life, if I'm Warren Buffett, for that transaction to happen, someone has to be buying and someone has to be selling. That's how the market works. Okay, so we have this construct, which is the market, and these prices are constantly being set. It's very hard for me to say, hey, my research shows me that I should buy this stock rather than the overall market. So this is like, again, this is, I think, is part of the journey that individuals have to go through before finding how to really invest themselves, right? So I also have to realize that I have much less resource than maybe other guys who are making calls in the market, who are buying and selling stocks. So I heard a really great analogy recently, right? Me picking stocks is like using a toothpick to fight against an aircraft carrier. Okay, the aircraft carrier on the other side, they will have the fastest computers in the world. They will have tons of people researching stocks day in and day out, quantitative and qualitative. There are even hedge funds that buy satellite imagery to record the number of trucks leaving a factory to understand if a particular company is going to have more sales at a particular time.
I don't have that
So
resource, yes.
we don't have those resources. They spend tons of money every year, millions and millions of dollars, on buying up credit card data, all this different stuff. And even those guys, even these hedge funds, more often than not, fail to beat the market.
Okay.
So taking my toothpick against the aircraft carrier, I prefer to ride on the aircraft carrier. I think it's a much safer approach. When it comes to income, I think REITs are very popular. But rather than owning just REITs that generate income, there are plenty of things that generate income. So why don't I buy a more diversified set of companies and assets that are able to generate income and spit out dividends on a recurring basis. So again, it goes back to that concept of just diversification, so that as you diversify more, you have a higher probability of being compensated by returns. So for us, it's not about trying to maybe, get a really fast return really quickly. It's more about making sure that I have a reasonable way to get a reasonable return given the risk that I am taking.
To reach your end goal too. Okay, I'm pretty sure that's quite a lot for the viewers from hearing from two of them. That's quite a bit to digest. I guess one question I have for Jun Xi is this. We mentioned about you speculating. That's where you learn a lot also. Is there any other challenges in your this 11 years of journey in investment that you would like to share with the viewers?
Okay, I think I will share my own personal experience first. When I started investing very early in my 20s, right? I heard about this investment scheme from my friend in NS. So he was saying about investing in, so back then it was gold. That was 10 years back. It was gold.
Yeah.
So now if you think about current terms, it might be cryptocurrency or stock pick or whatsoever. So that investment scheme, right, promised a return of 20% every year. So I thought, wow.
Wow.
Brilliant. 20% a year.
Yeah.
In 5 years, I'll be double money. So that was the whole investment scheme all about. So I put about 5K inside. And safe to say, 10 years later, the 5K has become zero. I've not got a single cent back.
Yeah.
So I mean, so to the viewers, right? So when I started first investing, right, you will obviously be attracted by high returns, definitely, because you'll see, will associate high returns with investing. But be very careful of what you're investing in. Always do your own research. Is the company or product you're investing, is it regulated? Is it licensed by the MAS? If it's not, my advice to you is stay clear of it. So in the crypto space nowadays, right, it's very popular nowadays, crypto.
Yes.
Yeah, so if you look at crypto firms across the board, how many of them are licensed or regulated by MAS? I can tell you very safely, 90% or even 99% of them are not regulated or financed or licensed by MAS. So are you comfortable putting that money in such investments? Me, the answer is very easy, no. So yeah, so before you invest, always do research into the product itself. What are you investing in? And is it a proper type of investment or not?
Yeah. I mean, hearing from you, there's the other word that came to my mind was scam. I don't know about you guys, but wow, some of them looks legit. We see it in YouTube advertisements of videos and all that. So maybe across the entire panel, what are the kind of tips that we can give to our viewers, to share with our viewers, how to avoid scams? Maybe Hui Bin, you can start first.
I think first thing is you check that the company that you're dealing with is not on the MAS investor alert list. And second, but of course, this alone is not sufficient. You have to do your research into the product that you're buying, just like what Jun Xi has mentioned earlier. In particular, don't just focus on the expected return that the product promises. You also have to consider the risk and assess whether you're comfortable with the risk in the product. Risk meaning how much I can stand to lose, what is the maximum amount of loss, under what circumstances this loss can happen. And also, because all investments come with risk, so you have to look at not just the expected return, but also the risk part. Then, well, to get a good grip on the risk of the product, you do your research, and then you can find out more about the product, and in particular, try to understand how the company or product makes money in order to generate the promised return. And another red flag of scams is they offer you rewards for bringing in new investors or new monies into the scheme, because this shows that it may be a Ponzi scheme, meaning they are using the monies from new investors to pay the earlier investors.
Okay.
I think the only other point I would add is that if someone's guaranteeing you a very high return, like Jun Xi mentioned the risk-free rate earlier, maybe around 4%. So if someone's even guaranteeing you 6%, like guaranteeing, okay, I would already raise an eyebrow. If someone's guaranteeing me 10%, I would say this is highly unlikely. If someone's guaranteeing me 20%, I would just walk away. If it's too good to be true, it's likely, not true. And you need to use kind of your spidey sense on that. But just know that the financial markets are pretty efficient.
Yeah.
And guaranteed returns without risk, guaranteed returns are very, very hard to come by. Yeah.
Yes. Okay. Now, I think we have a lot to digest today. I think aside from the scams, we also want to touch a little bit before we move into the Q&A session. If there are any other common mistakes that you see your friends or the investors making, when it comes to investing, are there any other common mistakes that we have not covered today?
Yeah, I'll just run through a few slides very quickly.
Of course, go ahead. Yeah.
Yeah. So, this is a CPF investment, talking about CPF investment panel, and I think that we need to understand how the CPF OA rate is defined and created. There's a very clear definition on the CPF website. CPF is very transparent on how it's defined, and what we have here is the savings deposit rate and then the CPF OA rate over the same time. So, historically it was tracking that, but then CPF generously kept it at 2.5% for basically since 1999 until today, even though the savings deposit rate was significantly lower. So that's 2.5%. And what people don't need to understand is that I'm using the exact same chart,
Okay.
and I'm now layering on the annual stock market returns. So same chart again, now the stock market returns. You see the chart, the left side went from 0 to 5% to negative 40 to positive 40%. Okay, so huge difference, but this pays off in the form of a longer term return. So if you had your money in CPF without, with government risk only, so basically with very, very low risk, 100,000 became 245,000 over that period. If I had invested that money in globally diversified stocks, for the first 7 or 8 years, you would have been kicking yourself, you see, because it was under the line. And then you would have done well, and then it would have gone down by 40%. You would have been kicking yourself again, saying, why didn't I sell? It would have gone up. It would have gone down again by 50% during the global financial crisis. You would have again been kicking yourself. And then COVID, negative 30, most recently negative 20. But after all of that, you would have about a 5.4 times return on your money. Okay, so that is what investing looks like. It's about collecting returns for the risk you take and compounding them over time. And that is what you need to ask yourself before investing, right? You need to ask yourself if you're willing to trade that guaranteed return, and we talked about the risk-free rates, that guaranteed return for a higher return if you have the time to get there. So there's a $287,000 difference in the index return versus that. Then, when we talk about time and risk, I mean, this is a very good chart to understand, okay, what if I invested in global bonds only for 10 years versus CPF rate? Over a 1-year period, I might underperform. Over a 3-year period, 97% chance of outperforming. 5, 10, 15, 20-year period, I would have outperformed, historically looking. Okay, this is on a rolling monthly period. Stocks, once I get to the 10, 15, 20 years, I get closer to a higher success rate. So that's why understanding how much time you have is so important. And for most of us, our CPF OA investment horizon is extremely long. CPF is a wonderfully designed program. By design, it has mandatory savings. It gives you high guaranteed interest rates, higher than what you get outside. Before the withdrawal age, basically you can spend your cash on your daily expenses. You cannot spend your SA and your OA. But after the withdrawal age, what makes the most sense is actually to spend your cash first. But then to ever touch your OA, you need to spend through your SA, right? So then you have to eventually start spending your SA. And then your CPF OA is actually the last money you'll ever touch. So a mistake that I rarely see now is people reaching withdrawal age and then trying to take out all of their CPF. I think that trend has kind of passed.
Yes.
And the 30s, 40s, and 50-year-olds, they actually understand that CPF continues to give them returns through retirement and into their golden years. But what actually makes a lot of sense, I mean, if you can tolerate the risk, of course, is to invest your OA, because you will not touch it until you have withdrawn slowly, ideally, all of your SA. So I talk to friends and people who come into the office, clients we have calls with, and they're like, you know what, I did my calculation. I don't think I'll touch my OA until I'm 85 years old. Because I have all my cash savings that I'm investing now. I have my SA that's building and compounding at 5 and then 4%. I have my RA that's going to pay me my annuity. I don't think I'll actually have to start spending my OA
Right now.
until much, much later.
Yeah, much later.
So even if you're 60, you have 25 years. If I'm 30, I have over 50 years. And that is where the compounding power of markets can really do its magic.
I guess this also will apply to people who are not using their ordinary account for housing loan.
Correct.
That's majority of Singaporeans, including myself, using ordinary account to do that. But I see where you're coming from in terms of using a CPF ordinary account for investment. You have shown that it's not something that we do within a short time of 3 to 7 years. We need to have that kind of time horizon to afford.
Yeah.
Okay.
I want to add a point to caveat what Greg said about the CPF OA having a long investment horizon. Sometimes your personal circumstances may change. For example, suddenly you lost your job, and meanwhile you still have to service your mortgage. So you don't want to be caught in a situation whereby you're forced to sell your investments when the market is down maybe 20 or 50%. Just to raise funds to pay your mortgage. So this is something to keep in mind. So, ultimately, CPFIs is a member's choice whether they want to use their OA savings for investment. If they don't feel confident about investment, they can always use OA savings to pay their housing loan and reduce their liability first.
Yeah, we just have to, honestly, this discussion is really to let the viewers know the considerations of using OA, and aside from that, the bigger picture of building up your investment portfolio here. Yeah. Okay. Do you have, I think you have one more slide to go?
Just one more slide.
No worries, just
as a summary.
Yes.
Because you asked about, what to think about, and we call it 3 ingredients for investment success, like a very good soup.
Yes. I'm
there's-
hungry, yes.
Yeah, I know we didn't have, I thought we might get dinner when we came to the webinar.
I'm sorry.
But we didn't get any food. That's okay. So there's advice, access, and cost. So advice is invest towards your life goals at a suitable level of risk. Don't try to time the market. Access is to diversify globally, use professionally managed licensed funds, and evidence-based time-tested strategies, right? And an example of that is low-cost passive index funds. There are some now available in the CPFIS program and of course in the broader market. And then finally, cost. You need, what I mentioned earlier, watch out for trailer fees, right? Because the distributor or the person selling it to you may be incentivized to sell you funds or products that pay higher commission. And then definitely watch out for transaction fees, because every time you transact, you're getting clipped by a fee. Now, the transaction fee is also a bit dangerous, because I'm always trying to push you. A distributor may try to push you into more volatile products so that you have to trade them more often. And that's just something to watch out for, especially if you're just starting investing for the first time. Finally, I think Jun Xi mentioned the power of the fees compounding over time. If you keep your fees low, this can result in a huge difference by the power of compounding. So if you just saved 1% in fees per year, right, assuming an 8.5% return before fees. So if I just save 1% in fees per year for 30 years, and I ask this question, and people usually say, oh yeah, like I'll save 30%. But actually, with the power of compounding, I save 245% by just saving 1% in fees per year. That is the incredible power of compounding. And I'll stop there and pass you the, sorry.
Thanks for summarizing the conversation for us.
Yes, no,
Yeah, I think we need to give the panelists a break, a water break. Sorry, no dinner, but yes. We are going to go to the Q&A session very soon, but meanwhile, can we have the poll up for the viewers? Okay, we will have a pop quiz here, just 3 questions. And the first question goes like, I will consider the following factors before I invest money in a product. So there are 4 options here. Choose one. The product's expected return and risk, how much I can invest, amount of time that my money can remain invested before I need the money, and all of the above. Okay, I see that people are actually taking the poll right now. All right, let's share the results. Okay. Phew. Everybody's listening, or rather most of them, 90%. All of the above. Okay, yes, that's true. These are the 3 of the main factors that we should really consider when we actually invest our money in a certain product. Yeah, and actually what I really remembered from this entire discussion is really you have to diversify. Yeah, it's very important. And the next question we have right now is I am presented with an investment product that offers guaranteed return of 20% per annum, okay? So I will invest in this product. There are 4 choices here. Find out more, or you WhatsApp your family and friends about this wonderful investment opportunity, or you invest a portion of my capital, and if you do get the return, invest more subsequently. Okay, so let's share the results. Okay, you're taking a poll, and 94% said that they will actually find out more information about it. Yeah, yeah. I mean, the other 6%, unfortunately, I don't have data of them. Otherwise, I could have sent EDM to them to educate them more. But anyways, the other 6%, I believe you're just trying to get our attention, right? Yeah, okay, next question, the last question. Okay, last question. John intends to,
Answer's there.
The answer is there. But this is, you know what, it's okay, no worries. I think they should know by now that really when it comes to investment, we really should diversify. And diversify actually give me that assurance that, okay, although I lose some, and I can win some too at that period of time. And the other thing is that at the long haul, I have to remind myself that, okay, this is what I want to achieve, so it's okay that this happens. Yeah. Am I right? All right. Thanks for sharing with us so much based on what you have experienced, what you have learned. And really, I'm pretty sure we went from 101 to a little bit on 201. Okay, but for the viewers, I will have to say this, take one step at a time. Okay, the very first thing that if you have not done, if you have already just started asking questions like, what kind of stocks I should invest, should I do stocks, gold, bonds, and whatsoever, before that, look into your profile. What do you really want at the end of the day, or at the end of 15 or 20 years, you know, what is it that your goal is, and your risk profile, okay, the time horizon, of course. And if you forget any of those, we will have this video recorded, and you can actually look at it in YouTube. We will have a post event EDM sent to you with the links. And other than that, we actually have a lot of talks from CPF ourselves, and you can connect with us in Facebook, Instagram, download the CPF mobile app. What I really love is the podcast channel, because you can actually listen to this anywhere as and when you want to. Let's Talk CPF, and then we have our YouTube and Telegram channels too. Okay. All right, so before you go, if you have not filled up the CPF feedback form, please do. Oh, okay, sorry, I have one more slide here. Join us as a CPF volunteer today. I think it's really very interesting as a CPF volunteer. We actually help each other to actually learn more about what we can do with maximizing your savings in CPF, not only in CPF, but in investments. Yeah, so that's about it. Okay, all right, yep. So yes, we really do value your feedback, and I also do value our panelists' time. Thank you very much for joining us. Thank you, thank you.
It's a
Yep.
pleasure.
Thank you.
Thank you.
Bye.